From 1984 to 2015, Walgreens stock produced a 7,850% return and massively outperformed the S&P 500. However, the stock is now down over 80% from its all-time highs and is now selling for the same price as it was all the way back in 1997. This means that Walgreens stock has now lost 27 years of gains, which is absolutely insane. And due to the stock falling so much, it is now offering a dividend yield that's over 9% as well. This has caused many people to ask me whether Walgreens stock is looking attractive or if it is looking like a value trap. So in today's video, I want to go through Walgreens stock, its financials, its business, and answer the question of if the stock is looking cheap or if it should be avoided. However, before we get into the video, I want to let you all know that I will be attending the Blossom event in Calgary on July 15th. The event is being hosted at Craft Beer Market from 5 p.m. to 9 p.m., and I will be there to meet you in person and hang out for the night. I'll leave a link in the description on where you can get your tickets if you're interested in coming and meeting me in person. Also, if you have a copy of my book, The Fundamentals of Investing, then bring it along, as I would be happy to sign your copy. But with that being said, let's hop into the video. Alright, so to start this video, I want to head over to Stock Unlock Insights to see how this platform is scoring Walgreens stock and see if there's any red flags. So right away, we can see that it has an overall score of 2.29, which is bad. The profitability score is also a 1.67, which is pretty dang bad. The gross margin is only 18%, the operating margin is only 1%, the net margin is negative, and the free cash flow margin is negative as well. So Walgreens is actually losing money right now, and it is not a profitable business. The management score is also 1.67, which again is pretty bad. The ROIC is actually surprisingly high at 13%. But ROCE is bad. Return on equity is negative 43%, return on assets is negative 7%, and the stock has underperformed the S&P 500 massively over the past 5 years. The company's growth score is 2.5, with revenue actually growing by about 7% over the past year, but its gross profits are decreasing, its net income is decreasing, and its operating cash flows are all decreasing. So revenue is going up, but the actual profits for the business are continuing to go down, which is not a good thing. The financial health is also bad, sitting at 2.17. Since the company is unprofitable, it means that it has about 9 months left of cash on the balance sheet. The current ratio is also below 1, which is a pretty bad thing, especially if the business is losing money, because if the current ratio is below 1, then it means that the company has less current assets than current liabilities, which essentially means that the business does not have enough liquid assets to pay off its debts that are due within the next year. And a current ratio below 1 isn't so much of a problem if a business is profitable and it has cash flows coming in, but when a business is not profitable and it is losing money, then a current ratio below 1 means that the company could run into some strong financial stress within the next year, and that is not a good thing to see. Walgreens also has a lot of intangible assets, its shares are growing slightly, and its debt to EBITDA ratio is 2.2, which is all around not very good. The dividend score is also sitting at 2.33. Its current dividend yield is above its 5-year averages, but its dividend per share has actually been declining. And Walgreens did lower its dividend recently because it really needs to do so because the business is currently losing money. And when a business is losing money, then in my opinion, it actually should not be paying a dividend at all. So when we take a look at Walgreens Insights scoring here, we can see that its dividends are declining. Its growth is also not really good. The revenue is growing, but its profits are all going down. Its balance sheet kind of sucks. It doesn't have a high current ratio and the business is losing money. The management has also underperformed the S&P 500 and the return on equity and return on assets is very bad, and it is not a profitable business at all. All of its margins are bad, and the company is actually losing money with negative net margins and negative free cash flow margins. So all around, this business does not look like it has very strong fundamentals at all. So now let's take a little bit of a deeper look into the company's actual financials here. And if we scroll all the way out to 1990, we can see that Walgreens revenue was growing very strong from 1990 to about 2018 actually. And really since about 2015, the company's revenue hasn't been growing that much. What's also interesting is Walgreens revenue is sitting at an all-time high right now. So the company's revenue is actually continuing to grow and hit all-time highs. However, if we take a look at the company's gross profits, we can see that they have been declining over the past about 8 years now, and they're continuing to go down. This is the exact same story with the company's operating income, and the operating income has dropped massively since 2018. Back in 2018, it was doing about $7 billion in operating income, and now the company is doing about $2 billion. So operating income has dropped by like 60 to 70% over the past 6 years. Net income has also declined massively, and it is now sitting at negative $5.8 billion from its high of about $6.4 billion in 2021. So overall, once again, we can see that Walgreens revenue is continuing to grow, but its overall profits are not growing with the revenue, and that is not a good thing to see. Now, if we head over to the cash flow statement, we can also see that operating cash flow grew very nicely from 1990 all the way to 2017, but it has absolutely fallen off a cliff. And now it is only sitting at $727 million in the trailing 12 months. If we also take a look at free cash flow, this is the exact same story. Walgreens free cash flow has declined from $7 billion down to negative $900 million in the trailing 12 months now. And this ultimately means that the business is losing money now. It is no longer a profitable business. Now, lastly, I want to go and take a look at Walgreens margins here. And we can see that its gross margin has been steadily declining since about 2013. And this is not a good thing to see at all. Now, if we take a look at the operating margin, we can also see that it has fallen off a cliff and it is now sitting at only 1.36%. And then finally, we can see that the free cash flow margin has also dropped off a cliff and it is now in the negative territory because the business is in fact losing money. And all of this, again, is not a good thing to see. So then I was wondering, why are Walgreens margins shrinking so much? And as of its most recent earnings report, it says that its retail margin was negatively affected by increased promotional activity and higher shrink levels. And shrink levels are essentially theft. So Walgreens is having to do more discounts and promotions to drive sales. So while sales are actually growing, the profits on these sales are going down due to all of the discounting. This is also a sign that a business does not have a moat or any strong pricing power, which I do see as a pretty large red flag. So on that note, let's now take a look at Walgreens' most recent financial report here. And right away, we can see that its adjusted earnings per share was down 36.6% year over year, and the company said that it is experiencing a challenging US retail environment and recent pharmacy industry trends. Third quarter sales did increase, though, by 2.6% year over year to $36.4 billion. And then Walgreens also lowered its fiscal 2024 adjusted EPS guidance to $2.80 to $2.95, reflecting once again a challenging pharmacy industry trends and a worse than expected US consumer environment. And lastly, the company said that it is finalizing significant multi-year footprint optimization program to close certain underperforming US stores. So overall, in the most recent quarter, Walgreens saw a 36% decline to its earnings per share. It did see its sales grow by 2.6%, but then it lowered its earnings per share guidance for 2024, and it announced that it is going to be closing more stores. So overall, it looks like Walgreens is not having a very good time right now. In fact, Walgreens announced that it is planning to close up to 2,000 stores as the stock is down 88% from its all-time highs. So the business is really seeming to struggle with profitability right now. However, when we take a look at Walgreens' year-to-date results, we can see that sales in the first 9 months were up 6.2%, adjusted operating income was $2.2 billion, which is down 31.5%, and then down here they say that net cash used in operating activities was $314 million in the first 9 months, and free cash flow was negative $1.1 billion, a $1.2 billion decrease when compared with a year ago, which each driven primarily by lower earnings, a $780 million in higher payments related to legal matters, and a phasing out of working capital. So when we take a look at the year-to-date results, Walgreens has actually lost $314 million in operating cash flow, and the company now has negative $1.1 billion in free cash flow. So its operations are losing money even before we factor in capital expenditures, which is not a good situation for a business, especially one with a weak balance sheet as well. So now let's actually move on to Walgreens' cash flow statement, which is my favorite financial statement here on the channel. And right away, we can see that Walgreens had accrued litigation obligations of $333 million in the first 9 months of this year, whereas last year they were $6.8 billion. Now, this is a new metric right here on a cash flow statement for me. So I actually went and found what this number right here is. And at the end of 2022, CVS, Walmart, and Walgreens all agreed to pay $13.8 billion to settle US claims. Walgreens in specific said that it had agreed to pay about $5.7 billion over 15 years, and neither company admitted to any wrongdoing. So essentially, Walgreens now has a $5.7 billion legal obligation to pay back to, I guess, the US government. And every year for the next 15 years, it does have to pay somewhere around $300 million to $500 million in legal fees to the US government for this fine. And overall, this is not a good thing to see at all from a business that is currently struggling with its overall profitability, and the entire business in general is really struggling. So to slap on a $5.7 billion fine to a struggling business is not a good place to be at all. But let's move back over to the cash flow statement here, and we can see once again that the net cash provided by operating activities was negative $314 million, compared to $1.2 billion last year. Then we can see that the capital expenditures so far on the year are at $1.1 billion, which means that the company's free cash flow is actually negative $1.4 billion. So this company is losing a significant amount of money. Then we can see that it has proceeds from sales, leasebacks, transactions of $773 million. Now, for those of you who may not know, a leaseback is an arrangement in which the seller of an asset leases back the same asset from the purchaser of the asset. It's essentially the business selling an asset, then leasing it back from the seller. And this is a way for a business to sell its assets for cash or to raise cash, but keep those assets through leasing them back from the owner. And ultimately, again, this is a way for a business to raise money, which I do think that Walgreens needs. And then we can see here that Walgreens does have a $1.7 billion income from the proceeds of sales of other assets. So basically, Walgreens' capital right now is coming from sales, leaseback transactions, and from selling off assets. And in general, this means that Walgreens is surviving right now off of selling assets altogether. Now, what's interesting is Walgreens bought back $1 billion worth of stock so far on the year, and then also paid a dividend of $168 million. Now, I have a big question mark right here, because this is a business that is losing $1.4 billion so far in 2024, yet then they used $1 billion to buy back shares and pay a dividend of $168 million. Now, while a business is losing money, and the business is clearly struggling, I mean, it's having to discount, its profitability is going down, its margins are shrinking, its profits overall are actually negative now, yet it still wants to spend its money on buying back shares. To me, this is absolute idiocy. This makes no sense, and I think that this is a massive financial mismanagement from the CFO. I think that they're doing a terrible job here. If your business is losing money and your business is struggling, and you also have a bad balance sheet, and you're having to sell off assets, then why are you buying back $1 billion worth of shares? That doesn't make any sense to me. And when you follow the money here, where this money is actually coming from, it's coming from the business selling off its assets. So quite literally, what Walgreens is doing is it's selling off assets and then using that capital to buy back stock while the business is losing money. So all around, this doesn't make any freaking sense to me. And again, I think that the CFO of this business and the management of this business is doing a terrible job. This is just like, this is something that gets my blood boiling because it makes no sense. And right away, this level of financial mismanagement immediately tells me that there's no way I would ever own this stock, until at least the management is fired and there's new management in there. Because this is total idiocy. I would not ever own a stock where the management is doing something so stupid. So yeah, by taking a quick look at this cash flow statement alone, the stock is already a hard no for me. That's just what it is. Now, if we head back over to Stock Unlock, we can take a look at Walgreens dividends paid versus its free cash flows over time. And the dividends paid is the green line, and then the free cash flow is the more brown line. And we can see that historically, the free cash flow actually did cover the dividend because the free cash flow was higher than Walgreens' dividend. But now we can see that free cash flow has fallen off a cliff, and now the free cash flow is well below the dividend payments. Now, what this ultimately means is that Walgreens' 9% dividend yield is not very safe at all, because they don't have organic profits actually fueling these dividend payments. As we saw in the cash flow statement, what's actually fueling these dividend payments is Walgreens selling off assets, which is not a sustainable dividend model at all. And in my opinion, Walgreens should just cut their dividends altogether and save that money while the business needs it and while the business is actually losing money. This is a very risky dividend, in my opinion. And this is this is one of the risks of seeing those higher dividend yield stocks like at 9%, because you cannot be enticed just by the dividend. You actually have to take a look at, okay, well, how is the business paying that dividend? Does it have the profits to pay those dividends? And where is the money actually coming from to pay those dividends? And in Walgreens' case, the money is coming from selling assets, which again is not sustainable at all. So I think we have identified that Walgreens is not a good business right now at all, and it's not a stock that I would consider owning anytime soon. So then my next question is like, how did the stock do so well from 1984 to 2015? And then what happened here? Like, what caused this business to see its stock fall 83%? And if we go and take a look at the business's financials as well, and we head over to the income statement and go to the operating income, we can see that here in 2018 is really when the operating income started to fall off a cliff. So I went over to Walgreens' 2019 report, and it says operating income decreased by 20.5% to $5 billion. Operating income in the fourth quarter decreased by 37% to $878 million. So this is really when things started to go wrong over at Walgreens. Then it says company raised its annual cost savings target in excess from 1.5 billion to in excess of 1.8 billion by fiscal 2022. So the company's operating income was declining, and then it announced that it was going to start a cost savings program that was going to save the company 1.8 billion. Then the company introduced guidance of roughly flat growth in fiscal 2022 for its earnings per share. And the CEO said, "We are pleased to report fiscal 2019 results in line with our previously stated guidance despite a challenging operating environment." Now, do you guys remember near the beginning of the video and the most recent quarterly results when the CEO said that it was in a challenging operating environment? Well, the CEO has been saying this for 5 years now. So for the past 5 years, Walgreens has been in a challenging operating environment. Now, in my opinion, at some point, you just have to take ownership. There's a point in a business where, you just got to say, listen, we're dropping the ball. We're not doing a very good job. And you can't just continue to blame your business's failures on a challenging operating environment. Like, what does that even mean, right? This is a huge red flag to me that for the past 5 years, the CEO has continued to say, we're in a challenging operating environment, and that's their rationale for the business performing so poorly. This is not good. We remain confident and are positioned to deliver long-term growth. While we still face headwinds, I am encouraged by the improvement in the US comparable sales performance in the second half of 2019 and our progress in managing costs in order to save and invest and grow. We are introducing guidance for fiscal 2020 adjusted earnings per share, which we expect to be roughly consistent with 2019 currency rates, very much in line with our expectations. So back in 2019, the CEO also said that it was expecting the business to actually continue to grow past 2019. So then I went to Walgreens' 2022 earnings report here, and we can see that EPS dropped by 31.8%. And then in 2022, at the end of the year, Walgreens said that it was expecting fiscal year 2023 EPS of $4.55 right in the middle range, which essentially means that it was expecting its earnings per share to grow quite significantly in 2023 versus 2022. The company also said that it has increased visibility into the company's long-term growth algorithm, building to low teens adjusted EPS growth in fiscal year 2025 and beyond. So back in 2022, Walgreens was saying that it was expecting its earnings per share to grow by double-digit growth rates through 2025 and beyond, okay? Remember that. This is what the company CEO and management was telling the public and telling shareholders, that they were expecting double-digit growth rates to earnings. Fiscal 2023 will be a year of accelerating core growth and rapidly scaling our US healthcare business. Now, if we go and take a look at the actual 2023 results right here, we can see that fiscal 2023 loss per share was $3.57, okay? An adjusted EPS was $3.98, down 20% year over year. So they projected strong growth to EPS, and then they actually saw EPS decline in 2023. Then they said that they are expecting fiscal 2024 adjusted EPS of $3.20 to $3.50, and then they're not providing guidance beyond 2024 anymore. So they basically scrapped that double-digit earnings per share growth to 2025 and beyond, guys, right? And they're expecting, again, $3.20 to $3.50 in EPS for 2024. Well, as of their most recent earnings release, they have lowered their 2024 adjusted EPS guidance to $2.80 to $2.95. So what I am noticing here is this business has a trend of issuing this guidance that is way too optimistic and way too rosy. I mean, they're consistently telling the public and telling their shareholders that they're going to hit these guidance and these growth rates, and then they come in, they absolutely miss them by a wide margin. EPS has declined, it continues to decline, and then they continue to lower their guidance. Now, in my opinion, when a management has a history of not hitting guidance and basically kind of just spewing BS to the public, then it tells me that I should place no weight in what the management says at all going forward. I mean, think about it. Even back in 2019, this company was saying that it was going to continue growing strongly all the way out to 2025 and beyond. And then year after year after year, they see the business continue to decline. They continue to put out these rosy projections, they miss them, they lower them, and then they just continue doing that. So in my opinion, again, why would you trust this management team? Also, they have continued to say that they are in a challenging operating environment for 5 years now, and in my opinion, that is just them not taking any accountability for their lack of business performance. So to wrap up this video, I have a summary of my thoughts right here. So right away, Walgreens is a great example that revenue growth is meaningless without profit growth. Because remember, the revenue for this business is actually continuing to grow by 6% year over year, and the revenue is at an all-time high. But despite the revenue being at an all-time high and growing, the actual stock is down 88% from its all-time highs. And the reason for that is stocks do not follow revenue. Stocks follow the profits of the business. And since Walgreens profits are now negative and the business is actually losing money, that is why the stock price is down so much. So again, stocks don't follow revenue, and revenue growth is meaningless if it does not translate into profit growth as well. Walgreens was also fined $5.7 billion, which is a huge red flag. I also believe that the management is mismanaging capital in a major way. The management has missed guidance since 2019 and continues to underperform. So again, why would I trust anything this management has to say moving forward? They have been in a challenging operating environment since 2019 as well, and they're paying dividends and buying back shares while the business is losing money and selling assets. And it has a weak balance sheet. Its margins are tanking. And this is a sign that the business does not have a moat and it is losing market share. It's also closing 2,000 locations, and in my opinion, this is a low-quality business with a poor management team. The dividend also does not look safe by any means, and it does not look like a stock that I would ever own. And these are the reasons why I wanted to make this video, because I know that a lot of YouTubers, and even on my own channel, I like to focus on stocks that are looking attractive or stocks that look like they have strong fundamentals. But I think that a lot of investing is actually just saying no to businesses with weak fundamentals or potential value traps like Walgreens. So I wanted to take the time in today's video to really explain what a fundamentally bad business looks like and what a value trap business looks like as well. And I think that Walgreens was a perfect example of that. In addition, I've also been being asked a lot about this stock recently. So I wanted to make a very in-depth video, basically showing you exactly how I do my research and how I came to the conclusion that this is not a stock that I would ever own. So I know that this is a little bit of a different type of video, and it may not be the sexiest video I have ever made, but it is still an incredibly valuable and important video, and I think that it is worth sharing with all of you. And if you did enjoy this video, then please remember to leave a like on it because it does really help out my channel. And if you're new here and you want to stick around and see more stock market related content like this, and to learn more about investing, then consider subscribing to my channel as well. And lastly, I just want to remind you all that if you do want to come and meet me in Calgary on July 15th, then I will put a link at the top of the description to go and get your tickets to the Blossom event that I will be attending. It would be great to meet you all there. Seriously, if you want to come and meet me in Calgary, then please do so. And if you have a copy of my book, The Fundamentals of Investing, then bring it along and I will be happy to sign it for you. Also, if you have not checked out my book, The Fundamentals of Investing, and you want to learn more about fundamental analysis and overall investing, then I will also put that link in the description. It's a fantastic book. I am reading it again on my own because I truly do think that it is a fantastic book. And if you want to go and read the reviews of the book on Amazon for yourself, then go and do so because it has strong reviews, and I'm not paying for these reviews by any means. They're organic reviews and natural reviews, and people have just loved the book. So go and check out my book for yourself on Amazon. Again, the link will be in the description. And that's going to wrap up the video for today, everyone. So thank you so much for watching. As always, I truly do appreciate it. And I really hope to see you all again in my next one.